Hi everyone, I'm Alan Rosenfield, Managing Director of Harmony Asset Management, and this is our latest edition of Thoughts and Comments titled, Is the Porridge Too Hot or Just Right? Just a week ago, the CPI, the Consumer Price Index, and the PPI, the Producer Price Index, were released, and the numbers were much higher than expected. These are measurements of inflation, and so it has the markets concerned. Just to give you an idea of how high they were, the CPI, the core rate of the CPI, was reported at 0.9% versus an expectation of 0.3%. That equates to a 4% rise in inflation when the Fed's own goal is 2%. So we're going to take a closer look at this and see whether we think inflation really is going to be an issue, or whether, like the government is trying to convince everyone, that it's completely transitory. So the first thing we're going to look at is, why is the government arguing that it's transitory? What they are using is what's called the base effect as their argument for why inflation is only temporarily high. Let's look at this first chart. This is a chart of the CPI going over the last 5 years. Look at the movement in the first half of 2020. CPI dropped, and that was because we were in the middle of the pandemic. But notice the rest of the curve. It turned around quickly, started rising back up to the levels where it had been, and by late in 2020, the slope of that graph had increased, which meant inflation rates were rising even faster. So when you measure CPI, you measure what's typically done year over year. So you look at the latest April numbers versus a year ago April, March of 2021 versus March of 2020. And yes, when you look at those dates, there was this basing effect because inflation was artificially low because of the pandemic. When everything came back, the jump looked much higher. So they're right about that. But that's a very short-term excuse, because by the second half of last year, inflation was already going back to normal rates. And when we look at it on a month-over-month basis, just looking at the first 4 months of this year, we're running at a rate of 6% inflation rather than the 4% that the annual would give you. So their excuse for transitory is very weak. Now let's do a deeper dive. We're going to look at the CPI and the various components and discuss what's going on inside. So stay tuned. The CPI is made up of various pricing models to see how prices are changing throughout the economy. One of the areas we're going to take a look at first is commodity prices. Commodities can be broken up into 4 areas: energy, metals, food, and other products like cotton or lumber. So we're going to dig into each of these and see how transitory those prices look. We're going to start with food, and more specifically with the grains. And the graphs that we're showing here are going to show soybeans first, and then we're going to focus on corn, as they're both very similar. We picked these two because they are in high demand around the world, and so they're good examples. What you see as we study the corn chart here a little more closely is there was a spike back in 2014 that lasted about a year. Then prices dropped rather dramatically, stayed low until 2021, and then we've gotten a spike again. And we saw similar things with corn, and you saw similar things with wheat. So the question is, what's going on, and is it transitory? Well, remember that when you're growing grains, you've got a short cycle. The growing season is one season, it's half of a year, or 3/4 of a year. So as prices change because of supply and demand, farmers can change what they plant, and therefore you don't tend to find spikes lasting very long. Now, what caused the spike? Well, what caused the spike in corn is the fact that last year there was a drought in the Midwest. And if you go back and look at 2014, you'll see the same thing. 2013, there was a very serious drought, much worse than the one this last year. But in both cases, you saw price spikes. But they lasted about a year, then supply and demand went back into balance, and they were over. So in terms of the grains, I'd say yes, very transitory. So let's look at meat, beef and poultry, the next two charts that'll pop up. These are very different, but again, they're both very similar to each other. Notice that they go down every now and then, but the trend over long periods of time has been only up, and they're continuing to do that. So it's fairly easy to look at history and say, very unlikely that price rises in beef and in poultry are going to be transitory. They typically aren't. When you look at metals, you've got nickel, aluminum, and zinc. And these are primarily used for specialty steels, although aluminum, obviously you have aluminum cans, but many of them are mixed together for specialty steels like stainless steel. And then you have copper, which is used much more as an industrial metal. So it's used in manufacturing. You've got it in semiconductors, you have it in cars, you have it in housing. So it's used much more broadly, which again means that it tends to be cyclical. Pandemic reduced the demand and supply, and coming out of it, you've increased that demand and supply. But there is a longer cycle when you get into the mining, because it takes longer to get mines up and running again. And then when you start getting into the products, so things like semiconductors, other things can make these still transitory, but slower. In other words, where it might be 1 year before you see prices come back down with food. With the metals, sometimes it can be longer. You might see it go on for 12 to 18 months. So it's transitory, but it won't be as quick through the system. And when you get to products, especially things like semiconductors, which are used in cars and used in computers and used in phones and used in medical equipment, used in all sorts of areas, that's going to make it have a bigger impact on CPI, because it's going to take longer to be able to build enough of the wafers, to build enough of the semiconductors, to get the plants up and built, all of this. So all of this takes time, and so your transitory nature is stretched out. The final area in commodities that we look at is energy. This is not transitory in my estimate, and here's why. When you look at oil and natural gas, they have the normal cycle that the pandemic put them through, but you also now have the current administration is focusing on expanding alternative energy and reducing the use of oil and natural gas. And they're doing this by reducing supply, by making it harder to actually pump the oil, to find places where you can go and drill it. But then they're adding on restrictions through new regulations that make it more expensive to pump oil or to transport oil. All of these increase prices and reduce supply. So the other side of the equation is demand. Well, let's take a look at that. Current expectations are for 10% of US people that have cars to own an electric car in 10 years. So let's double that and say it's 20% in 10 years. Well, that means 80% of those vehicles still need gasoline, and that's over 10 years. So that's not very fast. But at the same time, oil is a basic feedstock for many areas of manufacturing. Plastics, synthetics, chemicals. All of these areas use oil. And therefore, the demand there is not going to go down. So this is not going to be transitory. And I'd say that the government argument on this side is not even just weak. It's actually incorrect. So next, we're going to look at two other areas that affect the CPI. One is wages, and the second is government spending. Stay tuned. On to the next area, the CPI. We're going to look at wages. Now, wages historically are much stickier, and that means when you raise wages, it's harder to drop those wages unless you get a long and very serious recession. But what you do get instead is reductions in headcounts, either because you can't afford, so if you have a mild recession, or because of efficiencies due to either new inventions or new ways of applying current inventions so that you don't have to hire as many people. So while wages are stickier, the headcount can keep the wages from causing massive inflation. That's what we're going to look at closely here. So what we do know is that wages have risen dramatically since last year, especially among larger companies. We can look at announcements in the last few months from Amazon, McDonald's, Walmart, Costco, Target, all raising wages anywhere from $12 to as much as $16 an hour. B of A, Bank America, is the latest company to come out and announce wage hikes, and they are saying that they're going to raise wages to $25 an hour by 2025. So certainly that's going to cause inflation because of the stickiness. Like I said, though, what we're going to have to watch is what happens with headcounts. For instance, I was at the airport just a couple of weeks ago, and I ordered a hamburger. But I didn't go up to a counter and talk to a person. I actually went to a kiosk and typed in my order. Now, there are still people behind the counters packaging up everything and cooking everything, but they didn't have the extra people taking the orders. This is the way that companies can reduce headcount, and that can help control the inflation, because even though you're paying more, you're paying for fewer workers. When we talk about government spending, you've got temporary programs and you've got permanent programs. We're going to look at some of the temporary ones first and see how they're impacting things. So the first one we're going to look at is unemployment. Since the pandemic, unemployment benefits have been adjusted temporarily, they say, twice. The effect has been that 26 weeks of unemployment has now been able to be extended up to, in some cases, up to 86 weeks. And part of that unemployment is tax-free now. The first $10,500, actually you don't pay taxes on, even though you're getting the unemployment. When you calculate the numbers out, what you find is the unemployment is running, the unemployment benefit is running at close to a $16 to $20 an hour equivalent. Well, when you see that major companies are raising wages, but they're doing it somewhere between $12 and $16 an hour, that's forcing inflation. And many companies have admitted that they've had to pay bonuses just to try and hire workers. So this can be inflationary. The real question is, how long will they run this for? At this point, it runs through next September. Now, 16 states have already started cutting off those extra unemployment benefits because they are saying that it is having an impact on employment. And there is some ancillary proof of this. One is that you've got a record high of job postings out there, and yet they aren't getting filled. The second comes from the Federal Reserve data itself that shows that the number of people of working age that are actually employed is back down to 2015 levels. We're not even close back to the 2019, 2020 levels. And so certainly, even though the government is arguing that they're seeing no proof that all this largesse is keeping people from going and getting jobs, the reality in the marketplace is that it's having an impact. So now the question is this going to be temporary? Are they going to end it? Or will they come up with another excuse to extend it yet again? Now, I've had several friends scoff at me about this, but let's take a look at history. Ignore unemployment. QE, The Federal Reserve started QE in 2009 because of the housing blow-up, which of course was caused by the Federal Reserve's pumping money prior to that. It was supposed to be temporary. It's 2021. The Fed is still printing and still spending QE money. They haven't stopped it at all. Second example, Social Security. That was done under FDR, and it was a temporary program. Here we are 80 plus years later, we still have Social Security. The government loves to take temporary items and make them permanent because it helps them get reelected. So these are things that you may scoff, but you better be watching. Speaking of QE, let's look at what they're doing. QE, the Fed is spending $40 billion a month buying back mortgage paper to keep interest rates low. Housing's at all-time highs. Prices, demand, all at all-time highs. Why are they trying to keep interest rates artificially low? Makes no sense. They're doing the same thing with treasuries. They are spending $80 billion a month buying treasuries. So these temporary things have become addictive, and they're very dangerous. Another thing that we're seeing, M2, which is a broad count of the money supply, which is a good way to see whether you're going to get inflation in the future. M2 is up 24% over the year. Now again, part of that was due to QE, or part of that was due to the pandemic where they had QE and they've now done other programs. But these keep happening. They passed the last one in December, long after the pandemic had gone through its worst. And that was an extra almost $2 trillion. Now they're trying to do infrastructure spending. We'll have to see whether that really goes to infrastructure or whether it becomes, again, simply ways to pander. But if you're not getting money into the economy to build jobs, you're building inflation, but you aren't creating any value, and that's dangerous. Therefore, like I keep repeating, something that we have to watch. What is the bottom line? Is inflation transitory, or should we be worried that it's going to become more permanent? We know that from the commodity side, likely to be transitory. We know that companies, though, during first quarter reports were reporting that expenses were rising and that they were expecting to pass along price rises themselves. So we're going to have to be watching into the second quarter for CPI and PPI reports and further reports from companies as to what kind of expenses and what kind of price rises that they are experiencing or plan to pass along. The real key to this is going to be government spending, both the Fed's QE as well as government programs. Are these going to be temporary and they start to taper them? Or are they in fact going to be temporarily permanent? The Fed is talking about a tapering. That's a long way from tapering. We'll have to watch it. What this really means for investors is it's time to start looking at what inflation impacts will be on your portfolio. What are the risks and how do you change strategies? We think that the risk for inflation picking up and staying sticky is higher than not because, again, looking at history, the Fed has never gotten their timing right, so they'll be late to any party, and the government has never found money that they could spend that wasn't great for everything, regardless of what kind of inflation happened. We hope you found this helpful, and if you enjoyed the video, please like it. If you have questions, feel free to reach out to us. Thank you for listening, and we'll chat again soon.